Welcome to the chat. Tonight, we're diving into a hot question. Are we in an AI bubble, or is this the beginning of a long-term productivity boom?
I'm excited to dig into this. There's so much going on, from how AI is reshaping productivity to these lofty market numbers, yeah?
Right, exactly. So let's start with the basics. What makes a bubble in plain English? It's not just about rising prices. It's when those prices disconnect from the actual cash the companies can earn, fueled by cheap money, high leverage, and that irresistible new era narrative.
Yep. And that narrative can be dangerously persuasive, right? Even if the underlying fundamentals aren't as strong as the hype.
Yeah, exactly. When we look at the numbers, like the S&P 500 forward PE being in the low to mid 22s, or the Nasdaq 100 sales multiples near 7.3 times, it suggests that expectations are quite rich, raising execution risk.
Uh-huh. But isn't it interesting how those headlines like the Buffett indicator or the cyclically adjusted PE ratios remind us that high valuations can mean lower future returns?
Absolutely, it's like the market's painting this picture with bold strokes that, if not matched by real productivity gains, could lead to a correction. And speaking of productivity, there's some solid evidence emerging.
Right. I heard studies showing that generative AI boosts productivity in customer support and writing tasks, evidence that isn't just hype.
Exactly. Randomized trials have shown that AI tools not only speed up tasks, but also improve outcomes, especially for newer employees. And on a macro level, think about how, according to McKinsey, the annual potential value from generative AI could jump by trillions if adoption and process redesign happen effectively.
That's a huge range, from modest gains to a massive boom. But isn't there also a caution here? I mean, MIT's research cautions that improvements in productivity aren't automatic just because the AI exists.
Right. It really depends on which tasks are automated and how work is restructured. In simple terms, the deployment must be coupled with smart integration to actually free up capacity for real productivity gains.
Yeah, I got it. Now, shifting a bit, looking at historical parallels like the bubbles of 1929, 2000, and 2008, what lessons stand out for us when we compare to today's environment?
Great point. History tells us that 1929 wasn't a tech bubble at all. It was more about leverage and policy mistakes. In 2000, we saw companies chasing eyeballs without cash flows, and 2008 was about credit collapses, not valuation multiples per se.
Right. So, would you say that despite some similarities to 2000 in narrative, today's leaders are fundamentally different? They're profitable, have durable moats, and are cash generators in many cases?
Yes, exactly. The big tech names linked to AI now are delivering real cash flows. But there's a big concentration risk. Only a small group of these names drives a huge slice of market value, and that could be a vulnerability if things turn south.
I see. Now, just to challenge a point a bit, some argue that even if these leaders are profitable today, if broader adoption of AI stalls beyond pilot programs, wouldn't that make the high multiples hard to justify?
That's a fair challenge. The narrative works only if the productivity gains diffuse widely. If most companies only see pilot phase benefits without real, sustained process improvements, then you're basically paying a premium that may never be fully earned.
Absolutely, I get it.
And that's why it's crucial to not just look at the headline multiples, but also at metrics like operating cash flow conversion, post-stock-based compensation, unit economics, and return on invested capital versus the weighted average cost of capital.
It all circles back, doesn't it? The numbers really matter. If cash flow doesn't back up these towering valuations, then the market might be setting itself up for a rough correction.
Exactly. Prices are just the present value of future cash flows, discounted by risk. If things like the discount rate change, it can lead to massive swings in asset values. For instance, a small shift from a 9% discount rate to a 7% can make a big difference, especially for assets with long duration cash flows.
And that's why we see hypersensitivity to Fed policies and credit spreads, right? Any tightening could put real pressure on these high valuation stocks.
Yes, it's all interconnected. And speaking of interconnected, the playbooks for investors have become really nuanced. They're not just picking any cheap stock. They're hunting for specific things like solid balance sheets, margin of safety, and super competitive advantages.
Yeah, exactly. So, in an environment where sentiment can switch rapidly, is it wise for investors to lean on momentum strategies?
Well, momentum can help with timing, but it should be an overlay rather than the core thesis. Ultimately, quality and cash flow fundamentals need to drive investment decisions.
Right. Now, regarding the different layers in the AI ecosystem, the infrastructure, platform, and application layers, it sounds like each has its own risk-reward profile. Can you break that down a bit?
Sure, on the infrastructure layer, think chips, power, cooling, and networks. It's important to favor companies with supply advantages and long-term contracts. In the platform layer, you're looking at cloud services and model providers with strong user growth and revenue retention. And then in the application layer, you need clear evidence of workflow replacements, not just shiny co-pilots added to existing systems.
Yep. And if those workflow improvements don't materialize as expected, the economic case for those application providers could quickly falter.
Exactly, and that's where having a disciplined checklist becomes essential. Investors need to scrutinize things like unit economics, ROIC, and potential vulnerabilities such as high leverage or funding risks.
Absolutely. So, if we try to think practically, what should investors focus on over the next 12 to 24 months?
Great question. We basically have 3 scenario paths to consider. One is a soft landing with smooth AI scaling, where rates drift lower and enterprise rollouts transition from pilots to production, keeping capex high. The second path is an overbuild and cost shock scenario where GPU supply or power constraints hurt margins. And third, a credit or regulatory hit scenario could disrupt long-duration stocks the hardest.
Right, it's a lot to balance. And across these scenarios, the signals investors need to monitor are earnings versus expectations, unit economics, and the broader concentration risk in the market, isn't it?
Exactly. If you can't see clear productivity gains scaling across more companies, then those high multiples might simply be pricing in a lot of future hope.
We've seen that before with tech narratives. A few survivors tend to justify the dreams, while many others falter with disappointing cash flows.
Right on. And the difference today is that the leading names are, for now, massively profitable with durable moats. But we still need to be vigilant because if that concentration reverses, it can have ripple effects through the market and even affect household wealth.
Exactly. I find it fascinating how, despite all this innovation and real productivity evidence, the fundamental principles of valuation still hold. Discounted cash flow, for instance. DCF remains a grounding tool.
Absolutely. It's like a reality check. No matter how dazzling the AI story is, if the present value of future cash flows doesn't convincingly support the price tag, a correction is inevitable.
Yeah, absolutely.
And here's a key takeaway. For those AI-exposed names, the checklist has to be short and brutal. Check operating cash flow growth relative to revenue, assess moat durability, and always measure ROIC against WACC. If these basics aren't solid, then you're more in the hoping zone than a disciplined investment strategy.
Right, that's the crux. So bottom line, are we in a bubble, a boom, or maybe a bit of both?
The data point to 2 things at once. Some market sectors are stretched, yet there are credible productivity gains and strong fundamentals to be seen. It's a map that basically tells you if cash flows lag, then rules of thinning margins and multiples correcting will come into play.
Well said. And that ultimately underscores why a disciplined investor's checklist is vital. Respect the innovation story, but demand that the numbers back it up before you buy in.
Exactly. We've got to marry narrative with rigorous fundamentals. That's how you navigate this era of AI. Recognize the potential for a boom, but never lose sight of the traditional valuation metrics that anchor true value.
Right on. Thanks for the deep dive. This conversation really illustrates how multifaceted the AI market is right now. I guess the real challenge is staying alert as we see how these narratives play out in real time.